digging into your numbers, clearly there was a little bit of a dent as far as the taxation is concerned. And we understand there's a bit of a deferred tax liability in this regard. Maybe just give us more meat into what really transpired around this.
These are the taxes that will be paid in the future, and they arise from the investment allowance that we get as a result of investing or building power plants outside the municipalities. The Income Tax Act provides that any investor who puts investments outside the municipalities of Nairobi, Mombasa, and I believe Kisumu gets 150% investment tax allowance. But of course, as you make profits, it means that you'll have to pay this tax in future. Now, Julius, if I may just, if you recall, when the COVID-19 came last year, His Excellency the President, as part of the mitigation of the effect of the COVID-19, reduced the top tax rate, corporation tax rate, from 30% to 25%. And KenGen had to take this into account. And also the accounting standards require that where the rate has changed, your deferred tax opening must be based on the current tax rate. So we had to adjust our deferred tax rate from 30% to 25%. And Julius, because of that, we therefore released last year 8.1 billion into our P&L, and that was there. That actually moved our profit then, which was around 13 billion, after adjusting a bit to around 18 billion because of transferring back the deferred tax. But that decision was later reversed and taken back to the 30%. I think once the economy was assessed and the rest, it was reversed back to the 30%. And because of that reversal, we had again to adjust our deferred tax opening balance. And of course, by this time, we had taken the full effect of the Okare 5 power plant, 172 megawatt power plant. And now we had a slightly bigger deferred tax. And therefore, that meant that last year, the previous year, we had reversed 8.1. We had taken 8.1 as a result of reduction of the top rate from 30% to 25%. And now we had to revert back. And it meant that this year we have had to put back 8.7 billion shillings in deferred tax. But also, if you look keenly into accounts, we actually made a profit. And because of the profit, current year's tax, based on our performance for the year, attracted a tax of 4.5 billion. So we have made a provision on deferred tax of 8.7 billion plus this year's corporation tax of 4.5. So if you add those two numbers, it eats away a large chunk of the profit before tax that we had made of 14.7 billion.
Quite some heavy hit there on the taxation side. I'm moving on to my next question. I was really intrigued by the finance costs because it was a dip of about 5.2 billion or so. And curious to understand what exactly occasioned this sort of contraction as far as the finance costs are concerned.
The finance cost, and again, Julius, most of our loans, as you know, most of our projects are funded using foreign loans. These are the Japanese yen. We also have US dollars. We have euro, and we have other currencies. So if you look at these, the euro, the yen, the dollar, there's been a long, in the previous year, as a result of the COVID-19, Kenya shilling took a big hit on the major currencies. And that led to a big jump in the cost, the effect, the book value of our loans, of our foreign loans, as a result of the high, of the depreciation of the Kenya shilling. If you compare 2019 and 2020, there was a big jump. Kenya shilling weakened almost 108, I think even almost hitting 110. So we had to kind of revalue our loans, take into account the exchange rate, the closing exchange rate, to the level that increased. And according to power purchase agreements, foreign exchange gain or loss is a pass-through. So that means that you increase your level of loans, and then you increase, of course, also what is receivable in the long run because of that being passed through. It's kind of a derivative that you got. So our loans went up because of the weakening of Kenya shilling in 2020. But the difference recognized because recoverable recognizes as other income. But this year, if you compare 2020 exchange rate and 2021, Kenya shilling actually strengthened against most of the currencies. So the change was very, very small. So what was recognized in the income and also on the other side of the loan, the change was very small. And that's why the financing costs became less. So to summarize, finance costs for the other year increased significantly because of the exchange rate, Kenya shilling weakening against other exchange rates. That's creating a future, what we call deferred income, which will recover in future. On the other hand, this year, Kenya shilling strengthened significantly. So that deferred income became low. It was very, very small. So the finance costs, the decrease from 8.2 to 3 is occasioned by 5.1, almost over 5 billion decrease in the exchange because of the strengthening of Kenya shilling.
The dividend, and the dividend is of interest because looking at your numbers, your cash flow statement, it is my assessment that KenGen has closed the year on a relatively cash-rich position. If you could just give us a sense of what informed the proposed dividend given the closed financial year.
Yes, of course, as KenGen, we think of our shareholders and stakeholders, government being one of them, who actually gets 70%, and also the over 190,000 shareholders that we have. So we look at the fundamentals of the business, and if you look at the fundamentals of the business and how and the liquidity condition of the business, we felt that it is the time to share with our investors. So if you look at, as I said, the top line, we had a 4% growth. The PBT grew by 7%. And from the operations and the work we're doing in Ethiopia and the work we've done in Kenya and the cash that we had in our hand, we felt that there was a good enough reason to share and to reward our investors. Because the cash is there, we closed with a good number as a result of the operations. We made profit, even though bottom line, because that's just a provision. It's got no cash flow implication. It's only a provision, and we felt that it's good to give back to our shareholders. We've adopted. We have a dividend policy that guides our behavior, principally. And that is, we are supposed to pay either a third of our PBT or 50% of our PAT. So, of course, PAT, because of that deferred tax situation, which I've said is more of a book entry, it's not a cash flow. It's not cash flow. That was going to be very, very small. It wasn't good. We're only going to give like 0.9 cents per share. 0.09, very, very small. But if you look at the PBT level, as I've said, we made 14.8 billion shillings. So at that level, it makes sense. And then also, of course, the cash that we had, we felt that this is the right time to at least reward our shareholders. Julius, why we need to do this? Because we have to maintain certain debt equity ratios, and these shareholders, we are going to go back to them. If we are going to continue investing in this company in the future and doing our pipeline, our projects, looking at the long term, we have to maintain a 70-30 debt equity ratio. So when you have a situation where you have a bit of room, it's better to give back to them, so that when you go back, when you later we go back to the shareholders, for example, to raise some equity, then there's a good relationship. because people have invested in the company, they expect a return. The Energy Act also requires us to give a fair return to our shareholders. So based on how we do, it's a partnership. The debt lenders are getting their interest in advance. The equity shareholders also, if the conditions are favorable or can meet it, we also think of them.
Speaking about Ethiopia, which you just mentioned as far as diversification is concerned, the environment there has been a bit volatile of late, and just any investor looking into KenGen right now is wondering how to profile this risk from a pricing standpoint. What would you say around this?
I think I must say that the area where we operate, the Tulmoy area, is fairly safe. It's not in the area that has got any security risk. We also have a security. We've quite put a strong security team on the ground, and also our overall security team does continuous assessment. We are in a very secure area in terms of the location. So, and it's a project we are running for a while. We have staff in that area. In our own assessment, which we continue doing, and we get actual security reports almost on a daily basis, the area has no security risk. The events are taking place way far from where our staff and our project site is, very, very far.
A number of us are really concerned around the potential contagion of Kenya Power to KenGen, and what that means, given that they are the key off-taker of your output. I know there's little you can say around this area, but maybe just give a comment.
Well, Kenya Power are our partners. We are connected to the hip in the current environment that we operate in. I think their success is our success, and we're very happy that they are able to be seeing turning things around the way we've seen in the numbers that were reported. So to that extent, we feel very good. But I must say that even in terms of our relationship as we speak, we work on periodically, monthly. We have got a monthly financing plan. They have been doing their best to pay us on a monthly basis. They pay us plus minus 4.5 billion shillings every month, and that was part of the contribution, the cash that we have. Secondly, we are very proud that they have been able to look at their fundamentals, and we've noticed that they made significant improvement in terms of their transmission costs, and all the efforts they are putting in place. So we welcome, and we think that's very good, because they are our only customer. They were main customer. We have other customers now because of the diversification, but they were main customers, and therefore their success is our success, and we do applaud them for the effort that's taking place there as a team.
So do you have any unrealized revenue from them, and what's the plan in terms of how that's recovered?
We do have, if you look at our accounts, we close with around 25 billion shillings that they owe us. Part of that is current, out of that, but there's a part that's a bit over old. But as I say, we do discuss on a monthly basis. They give us a payment plan, and they have been honoring their payment plan. If I can recall, for the last 1 year, what is committed is paid to the cent, and therefore that has meant that the outlook is positive. We also appreciate all the strategic changes that are taking place at Kenya Power, and all the effort that government, together with other stakeholders, are putting into that organization. We believe things will turn around. So yes, as far as we're concerned, there's a big element of what they owe us in the books, but we are hopeful that the efforts that are being put will bear long-term fruit and be beneficial to us, and that this should be proved. But currently, on a month-by-month basis, they have been making commitments, and they have been meeting those commitments to us.
The KenGen share price, I don't know how you assess its performance in the bourse, because sometimes it looks like it's a bit subdued. Do you take note of this? What's your assessment? And are there any intervention measures in the pipeline, perhaps?
Yes, we are. Maybe 1 or 2 points. First point is that yes, we are aware that we are undervalued, and this is, this is an ecosystem. When you are in the bows, it's an ecosystem. People look at the fundamentals of the industry, of the sector. So I must say, to some extent, our share price has been affected by what's happening around in the sector in the last 1 year or so. The challenges that have been there have led to that. In terms of what we are doing, of course, we keep on trying our best, and this diversification effort is to make sure that shareholders can see that we're also getting some non-regulated revenue as much as we can. We're also looking inwards in terms of opportunity areas for improvement, to improve the top line, in terms of the many efforts that we are putting in place. We believe that once the fundamentals change and the perception change, KenGen will be one of the hotcake shares in that bounce. But as you can see, Julius, for yourself, a company that is doing what we are doing, the industry that we are operating in, we are delivering over 80% of the energy that's consumed in the country. We have 70% of the share index, of the market share. And we are delivering almost over 90% of our energy is renewable, which of course minimizes the effect of things like fuel prices and the rest. We are focusing on geothermal, and therefore, looking at the fundamentals, I'm very, very confident that one can see through that. And that's part of the actual decision that we make, including how we manage our P&L and how we manage our dividend policy, in addition to the things that we're doing. But of course, also, we coming out of COVID-19, of course, that kind of put in a lot on us. Yeah, actually, the result that I've reported here, there was even some element of COVID-19 force majeure, which already built into this, because we did pay something out of it because of just force majeure effect. So once everything is lined up, that's going to look good, and I'm sure the market will see.
The Energy Act of 2019 had the provision of open access, and I think it has gone a bit quiet because that would have significant implications for players like KenGen. Any status update as to how this matter is rolling out?
Well, I'm not an expert in that regard, but I'll make my comments that, of course, open access means that we can sell direct to the consumers, to the large consumers, and even to the county government, which actually is a provision, and others. So that presents a big opportunity for KenGen. But as of now, I think the ministry and EPRA are working on the regulations and the modalities. They need single system operator, and all that are now there's a committee, or an implementation committee that's working on how to implement the Energy Act, and these are some of the areas they are looking at very well. But of course, KenGen, when the opportunity comes and the door opens, it's something that we would want to look at very seriously as part of a strategic plan.